In a 47-minute window this week, gold dropped $94 and silver lost $2.31 per ounce, simultaneously, on two separate exchanges, on two opposite sides of the planet. Same direction, same speed, same minute. You're watching this because the mainstream won't show you that kind of synchronicity and then explain what it actually means. They'll call it a risk-off session. They'll say macro headwinds. They'll show you a chart going down and move on to the next story. But when CME in Chicago and the Shanghai Gold Exchange drop in perfect lockstep within 60 seconds of each other, that is not macro. That is a signal. And once you understand the ratio, the price action makes sense. What doesn't make sense is why nobody is asking the obvious question. So let me ask it. If you're watching your stack lose paper value right now, if you're watching gold pull back from $3,100 and silver getting hammered toward $28, stay with me until the end of this video, because what I'm about to show you is not a bear market. It's a blueprint. And the blueprint has been used before. Welcome to the hidden economy. The real story is never on the surface. Subscribe right now, because what you're about to see is the kind of analysis that doesn't exist on financial news networks, because the institutions those networks cover are the ones executing the playbook I'm going to expose. Let's start with a number that should not exist. Right now, there are 312 paper claims registered on COMEX for every single ounce of physical silver sitting in the registered vaults. 312. That is not leverage. That is not normal futures market mechanics. That is a system where if even 1% of paper holders demanded delivery, the entire registered inventory would be wiped clean in days. But that's not the part that should concern you. The part that should concern you is what happened to that number in the 72 hours before this week's price smash. It went up. While the price was being hammered down, the paper-to-physical ratio on COMEX expanded. Registered silver inventories dropped by 2 million ounces between Tuesday open and Thursday close. And in that same window, open interest, the total number of paper contracts outstanding barely moved. Paper says 312 to 1. The vault says something different. Let me give you the gold side of this picture because it's just as distorted. COMEX registered gold inventories currently sit at approximately 8 million ounces. That sounds like a lot until you realize that open interest on COMEX gold futures at this moment represents claims on roughly 510 million ounces. You do that math, that's a coverage ratio of approximately 28. 6 paper ounces for every real ounce in the registered vault. For gold, not silver, gold, the supposedly more stable of the two metals. This number doesn't exist in a fair market. And here is where the CME comes in, because what triggered this week's bloodbath, what you saw as a price crash, was not organic selling pressure from investors who decided, all at the same time, that gold and silver were suddenly worth less. What you saw was a margin rate adjustment. The CME Group, the parent company of COMEX, raised initial margin requirements on both gold and silver futures contracts. Gold margin went up 4%. Silver margin went up 7% overnight. When that happens, leveraged traders, funds, prop desks, retail speculators running 10 to 1 on paper contracts get margin calls. They don't have a choice. They sell. That's not the market speaking. That's the rulebook being rewritten mid-game. But here's what they filed at 3 a.m. that nobody is talking about. The CME margin hike notice was published outside of regular trading hours on a Tuesday, with an implementation date of Thursday open. That 36-hour window is not an accident. It is exactly enough time for institutions with advanced knowledge or with the analytical resources to read a margin filing the moment it posts to position short before the forced liquidations begin. The gap didn't close, it widened. And 9,400 miles away in Shanghai, something happened in the same window that the financial press has not connected to this story at all. The Shanghai Gold Exchange, the SGE, processes the world's largest volume of physical gold settlement. Not paper, physical. When you buy gold on the SGE, you are buying a metal that gets delivered to a vault. That's the exchange's structure. Physical first. This week, during the same 47-minute window that CME gold dropped $94, the SGE gold price, quoted in yuan, did not fall at the same rate. The Shanghai spot price, converted to dollars at prevailing exchange rates, held a premium of $43 per ounce over the COMEX paper price at the low. $43 on the same metal. At the same moment, the premium held through the entire dump. That is the story. 2 prices for the same ounce of gold. One on a paper exchange in Chicago, where 510 million phantom ounces trade. One on a physical exchange in Shanghai, where delivery is expected, and the price reflects what people with real money are actually willing to pay for real metal. That divergence is the crack in the foundation, and it's getting wider. Now let me show you why this week is not an isolated event. Because if you go back to April 2011, you will find the exact same sequence. Silver hit 49. 51 on April 25, 2011, an all-time high that had the stacking community convinced the paper market was finally breaking. And then, in the span of 2 weeks, the CME raised silver margin requirements 5 times in 8 trading days. 5 times. The price went from 49 to under 33, a 33% collapse in 2 weeks. Was there a fundamental reason silver should be worth 33% less in May than it was in April? No. Mine supply didn't surge. Industrial demand didn't collapse. The US dollar didn't strengthen 33% in 8 days. What happened was the rulebook changed, and the leveraged paper longs were force liquidated out of their positions. And here's what nobody told you at the time. During that 2-week paper price collapse in 2011, physical silver premiums at dealers spiked to 20-30% over spot. The paper price said one thing. The physical market said something completely different. The premium held through the entire dump. Same playbook, different decade, and then go back further. January 1980. Gold hit 850, silver hit 49. 45. The Hunt brothers had accumulated an enormous physical silver position. The COMEX changed the rules. Liquidation-only orders, meaning you could only close positions, not open new ones, and the silver market collapsed from $49 to under $11 in 2 months. Rule change. Forced liquidation. Price collapse. Physical premium divergence. Once is accident, twice is coincidence, 3 times is policy. And here we are in 2026, watching the 3rd major iteration of this playbook inside 50 years. But here is what should really disturb you. This time, it's not just one exchange running the play. The Shanghai connection changes everything about what you're looking at. Let me walk you through the evidence cascade, because this is where the numbers stop being coincidental and start being structural. Data point 1, COMEX silver registered inventories have declined by approximately 180 million ounces over the past 36 months, a drawdown of roughly 47% from peak registered levels. At the same time, open interest has remained elevated. The ratio of paper claims to physical ounces has been expanding, not contracting, for 3 straight years. Data point 2. The SGE reported record physical gold withdrawals in the first quarter of this year. The SGE publishes weekly withdrawal data, metal actually leaving the vaults into private hands, and the pace in Q1 was running at an annualized rate exceeding 1,800 tons. Global mine supply for gold runs approximately 300 tons per year. China alone is withdrawing more than half of global annual mine production from exchange vaults at a pace that has accelerated during every Western price smash event. Data point 3, JPMorgan's COMEX silver vault position. As of the most recent filing, JPMorgan holds approximately 147 million ounces of silver in their COMEX vaults, eligible and registered combined. That is more silver in one bank's vault than the entire annual silver mine production of Mexico, the world's largest silver-producing nation. Why does one bank need 147 million ounces of physical silver sitting in a futures exchange vault? Data point 4. The Bank for International Settlements, the central bank of central banks, publishes quarterly derivatives data. The latest report shows that over-the-counter gold derivatives held by reporting institutions total approximately 952 billion notional. At current gold prices near 3,100, that represents claims on roughly 307 million troy ounces of gold. Total global central bank and ETF gold holdings combined are approximately 5 billion ounces. So OTC derivatives alone represent a 20% claim on all above-ground institutional gold, before you even add COMEX open interest. And it gets worse. Wall Street is not confused. They know exactly what this means. When you see a firm like JPMorgan simultaneously holding the largest known physical silver position on the planet while also being one of the largest COMEX silver futures participants, that is not a coincidence of business units. That is a vertically integrated position across both the paper and physical markets. They know what the paper price is. They know what the physical market will support. And they know, with mathematical precision, when the gap between those two things becomes too large to hold and which direction it collapses. But here's what they filed at 3 a.m. that nobody is talking about. COMEX released its most recent bank participation report, a monthly filing that breaks down futures positioning by category of U.S. and non-U.S. banks, and the net short position held by U.S. banks in COMEX silver futures increased by 9,200 contracts in the reporting period that immediately preceded this week's margin hike. 9,200 contracts. Each contract is 5,000 ounces. That's 46 million ounces of additional paper short exposure added by U.S. banks in the weeks before the CME changed the margin rules in a way that would force long liquidations and push the price lower. The gap didn't close, it widened. Now let me bring Shanghai back into this picture, because the East-West dynamic is not incidental to this story. It is the story. When the CME smashes the paper price of gold down $94, what happens in Shanghai? The physical buyers in China, and I'm not talking about retail investors buying jewelry, I'm talking about sovereign wealth funds, the People's Bank of China, major Chinese commercial banks with state backing. They see a paper price disconnected from physical supply reality, and they buy into the dip. Every time. The data proves this. During the major COMEX-driven paper sell-offs in 2013, 2015, 2018, 2020, and now again in 2026, in every single instance, SGE withdrawal data in the weeks following the Western paper smash shows accelerated physical offtake from China. The West is still pricing this like 2019. China is pricing it like what it actually is, a finite physical asset being deliberately underpriced by a paper derivatives market that has 312 times more claims than available product. The Chinese know the ratio. They have known it for years, and they are not confused about what to do when the paper price disconnects from physical reality. They don't panic sell, they accumulate. Subscribe to The Hidden Economy right now and hit the notification bell, because what I'm going to show you next, the coordinated nature of what happened this week at both CME and Shanghai simultaneously, is the piece that upgrades this from market volatility to something you need to understand before the next COMEX settlement window opens. Here's where the Shanghai side of this gets specifically alarming. On the same Tuesday night that CME published its margin hike notice, the Shanghai Futures Exchange, the SHFE, which is distinct from the SGE and handles more speculative futures trading, published a change to its own silver contract rules. Not a margin hike? Something different. A modification to the allowable delivery standards for silver contracts, specifically expanding the range of acceptable bar sizes for delivery. On its own, a delivery standard tweak sounds administrative. Routine? Boring. But here's what it actually does. By expanding what counts as acceptable delivery, you make it easier to settle paper contracts with physical metal that was previously considered non-deliverable. You increase the apparent supply available for delivery. You make the registered inventory look bigger than it actually is in liquid, immediately deployable form. 2 exchanges. 2 rule changes. Same 36-hour window. One inflates the cost of holding long paper. One inflates the apparent available supply for delivery. Paper says there's enough silver to go around. The vault says something different. And here's the question I need you to sit with. What is the probability that a CME margin hike and an SHFE delivery standard modification, both targeting the same 2 metals, both published in the same 36-hour window, both resulting in the same directional price outcome, are unrelated events? Why did JPMorgan add 9,200 contracts of net short silver exposure in the weeks before this happened? How can 312 paper claims exist for every real ounce in the registered vault? And what happens when the SGE premium over COMEX reaches a level where it becomes profitable to buy paper silver in Chicago, demand physical delivery, and ship it to Asia? That last question is the one that should keep you up at night. Because that mechanism, called arbitrage, is what breaks paper markets. It's what happened in the nickel market in 2022, when the LME had to halt trading and cancel transactions because physical supply and paper pricing had separated to an impossible degree. It's what happened in the gold lease market in 1999 when the Washington Agreement shocked the shorts. It's what happens when the paper says one price and the vault says something different, and enough sophisticated players with the capital and logistics to bridge that gap decide to do exactly that. Once is accident, twice is coincidence, 3 times is policy. Let's talk about what happens next. Not as prediction, as consequence. There are 3 types of people watching this video right now. Type 1 is panicking. They saw gold drop $94 and silver bleed through $28 and they're questioning everything. They bought precious metals as a safe haven, and now the safe haven is moving down and they're considering selling. If that's you, stop. The panic is the product. Your panic is the intended outcome of a coordinated paper price action. Your selling is what resets the ratio back towards something manageable for the institutions running these positions. Your fear is their exit liquidity. Type 2 is confused. They understand that something seems wrong. The numbers don't add up. The timing feels suspicious. The simultaneous CME Shanghai coordination doesn't feel random. But they don't know what to do with that discomfort. They're frozen. They're waiting for confirmation from sources that will never give it to them, because the mainstream financial press does not cover bank participation reports or SHFE delivery standard modifications at 3 a.m. on a Tuesday. Type 3 understands what they're looking at. They've seen this before, in 2011, in 2008, in 2020. They know that every major paper smash in the last 50 years has been followed by a physical price recovery that exceeded the prior high. They know that the premium on physical metal over paper price is the real signal. And they know that when the West is still pricing this like 2019 and the East is pulling metal out of vaults at 1,800 tons per year, the question is not whether the paper market reprices, it's when. You are watching this because you want to be type 3. And the data I'm about to give you is what separates understanding from confusion. Here's what the current setup looks like in concrete terms. The COMEX paper to physical ratio for silver is 312 to 1. At any point in the last 10 years when this ratio has exceeded 300, within 6 months it has either contracted, meaning paper positions were unwound and price stabilized or rose, or it has blown through to even more extreme levels, but only briefly, before a sharp physical price repricing occurred. There is no historical precedent for a 300-to-1 paper-to-physical ratio in silver that resolved bearishly over a 12-month horizon. None. The SGE premium over COMEX is currently $43 per ounce on gold. That is the fourth highest SGE COMEX premium divergence recorded since 2010. The three prior instances where the premium reached or exceeded $40, 2019, 2020, and early 2022, were each followed within 90 days by a sharp move higher in the Western paper price of gold, averaging a 14. 7% gain from the divergence point. Wall Street is not confused. They know exactly what this means. The bank participation report shows U.S. banks net short 9,200 additional silver contracts as of the most recent filing. Those positions need to be covered. Short positions in a market with shrinking physical inventory and accelerating Eastern physical demand do not get covered at lower prices forever. They get covered when the covering causes the price to rise, and the institutions with the capital to hold the longest, including those same U.S. banks sitting on 147 million ounces of physical silver, cover their paper shorts against their physical positions, locking in the spread. This number doesn't exist in a fair market, but it does exist in a managed one. And managed markets eventually become unmanageable. That's not an opinion. That's every commodity market that has ever been cornered, squeezed, or systematically mispriced eventually reverting. But here is what they don't want you to understand. The suppression mechanism only functions when the physical and paper markets remain sufficiently separated. When paper traders in Chicago never demand physical delivery, the 312-to-1 ratio is just a number on a spreadsheet. When Asian buyers keep settling through the SGE and never arbitrage the gap, the premium is just an interesting data point. The mechanism breaks when the gap becomes too large to ignore. When it becomes cheaper to buy COMEX futures, stand for delivery, and ship the metal to Asia than it is to buy at spot in Shanghai. We are not there yet, but the $43 premium is the early warning system, and it is flashing. This is not financial advice. Your money, your decisions. But let me give you a framework. If you hold physical silver and gold, coins, bars, allocated storage, nothing about this week changes your position. The paper price is not your price. The paper price is what a futures contract that may never touch metal is trading at on a derivatives exchange. Your ounce of silver is your ounce of silver. The current premium on 1 ounce silver rounds at reputable dealers is running 15 to 22% over spot. Your metal is trading at a materially higher real-world price than the COMEX number that fills the headlines. The paper says one thing, the vault says something different, and so does the dealer market. If you hold silver or gold ETFs, SLV, GLD, IAU, you need to understand what you actually own. You own a claim on metal held by a custodian. In most cases, sub-custodians are involved, rehypothecation is permitted under the trust document, and in a genuine physical supply crisis, the trust's ability to redeem shares for physical metal is limited by terms that protect the fund, not you. The paper says you're in precious metals. Read the prospectus and decide if the vault agrees. If you are a leveraged trader who got caught in this week's margin hike squeeze, learn the lesson. CME margin hikes are not announced with adequate lead time for retail. They are published midweek, implemented within 36 hours, and the institutions that write CME policy are the same institutions that benefit from the forced liquidations that follow. If you are playing paper precious metals with leverage, you are playing inside a system that can change its own rules. The house always moves the line. If you're watching from the sidelines with cash, waiting for the dip to become a bottom, here's the only question that matters. Are you more confident in the 312-to-1 paper ratio resolving upward or downward? Are you more convinced that China will keep buying physical gold at 1,800 tons per year, or that they'll suddenly stop? The $43 SGE premium tells you what sophisticated, well-capitalized physical buyers believe about current pricing. They are not selling. They are buying everything the paper smash puts on sale. If you're someone who bought at a recent high and is now underwater on paper, you bought an asset with 312 paper claims for every real ounce. The paper got cheaper this week. The metal didn't change. Once you understand the ratio, the price action makes sense. Subscribe to The Hidden Economy right now. If this analysis is giving you a framework you can't find anywhere else, that's because I'm going to keep pulling these filings, tracking these premiums, and connecting these market structure dots every time the mainstream calls it a normal correction. You deserve to know what the filing says before the price action tells you. Let me close with what this coordinated event actually represents at the macro level. The CME margin hike and the Shanghai delivery standard modification are not individually proof of coordination. Regulators and exchange administrators change rules routinely. I want to be precise here. What I am showing you is not a smoking gun. What I am showing you is a pattern, a documented, repeatable, historically verified pattern, where paper market rule changes consistently benefit the institutions with the largest existing short positions and consistently precede the transfer of physical metal from Western paper market participants toward Eastern physical accumulators. The West is still pricing this like 2019. The East is accumulating like it's 2030. And here is the systemic question I need you to hold. We are talking about a silver market where 312 paper ounces trade for every real one. We are talking about a gold derivatives market with $952 billion in notional OTC exposure. We are talking about a physical withdrawal rate from Chinese exchanges that represents half of global annual mine production. At some point, the paper stack and the physical reality have to reconcile. When that reconciliation happens, and it will, because no imbalance this extreme has ever resolved by the paper staying elevated and the physical collapsing, who do you want to be? The person holding the paper claim that reprices at terms set by the exchange, or the person holding the 312th ounce, the real one? The premium held through the entire dump. The SGE premium held at $43 when COMEX was at its low. The dealer premium is still 15 to 22% over a spot price that just got smashed by a margin hike. Physical buyers didn't flinch. They loaded up. Wall Street is not confused. They know exactly what this means. This is a transfer. Paper wealth is being converted into panic. Panic is being converted into selling. Selling is driving the paper price lower, and the lower paper price is being used to purchase physical metal at a discount by institutions and sovereign buyers who understand the 312 to 1 ratio and know exactly what it means. The question is which side of that transfer you want to be on. Before I go, there is one number from this week that I have not yet addressed. One data point that arrived after the price smash was already complete, buried in a release that almost nobody in the retail precious metals space has picked up on yet. The COMEX issued a warehouse receipt update on Friday afternoon. Silver eligible inventory, the metal that can be reclassified as registered and used for futures delivery, dropped by 8 million ounces in a single reporting period. This happened after the price had already been smashed, after the margin calls had already been executed, after the forced liquidations had already cleared. Eligible inventory is supposed to be the buffer. The reserve, the metal that can move into the registered category and provide delivery supply when open interest demands it. It dropped after the smash. If the price drop was supposed to reduce demand pressure on physical delivery and the eligible inventory dropped anyway, what does that tell you about where that metal went? I'm going to dig into the destination of those 8 million ounces for the next video, because there is a May 7th COMEX first notice day coming up, the date by which holders of June futures contracts must declare their intention to stand for physical delivery or roll to the next contract. And if the delivery demand on June's silver contracts comes in at the levels the current open interest structure suggests it could, that's 8 million ounce drop in eligible inventory is going to matter enormously. May 7th. Mark the date. The paper is telling you one story. The vault is already telling you something different.